think it's this Shashir. He says, how would one invest trade MCD, PG, i.e. low beta stocks? I'd still approach it as a married put. I'm going to have a low risk position following the rules in the blueprint, right? And I'm going to collect the dividends. And I'm going to have availability to do income methods on those positions. So let's just go search by symbol. I'll use Mickey D's. And I'm going to use that for, actually it's not. It's one I've always considered. Let me go out full January. Let me see if there's any radioactives. This is the search by symbol rather than the search tool for married puts. Okay, nothing matched the radioactive, so let's just go to more. Doesn't mean that they're not bad. It just means that maybe there wasn't any open interest on the strikes that would have matched the criteria. Donald's is at 290. So I go right at the money with a 290 strike for a year out in time and only have a 5.2% risk. I can collect the dividend. I can go up and sell 295 calls to act like an every 2-week dividend payment on that. I know I'm only expecting maybe a 6, 7, 8% growth on this position, you know, in a consistent market. But if the market still exceeds expectations, hey, it's going to go up as well. That's my approach. You want something more consistent instead of the longer term guaranteed limited risk. You might look at a standard collar, but the returns are going to be shallow. I mean, the premiums would be the premium return here using an income method number one or selling a call against this longer term married put would also be pretty shallow because of the low volatility. All right. But that's the case. It might use a standard collar as well. Okay. Now, the reason I used McDonald's is because I mentioned this in other webinars. At times when the market is tenuous, volatile, I'll still open new married puts, but I'll go ahead and link back to what I call touchstone stocks. I'll open new married puts to still collect some dividend, income, i.e. dividend on Johnson & Johnson, Mondelez, which was Kraft Heinz, positions like that you're mentioning as a safe haven with the protection in place. Naturally, here comes the conversation. We're not going to go all the way through it. He says that's a lot of money invested. Can deep in the money call with the married put be not better? No. Okay, that is not the same structure at all. That's not risk controlled. When you do a deep in the money call and buy the put, you create an in the money long strangle. And what that does is create what we like to refer to as Death Valley or no man's land. You need a much bigger movement up or down, but you need a much bigger movement up than you would with a standard married put in order to start realizing a profit. Everyone says, oh, you can just go deep in the money with a near one delta and no time value. Yeah, but when you look at those options, there's no open interest and there's no volume. It's impossible to get filled on those positions realistically. So you're still going to pay time value into the call. We've done a lot of discussion on this, but you're still paying time value of the call and you've got the time value of the quote unquote married put. So you create, as I mentioned, an in the money long strangle instead of the married put. Yeah, you've saved capital, but let's take a look at it. The other thing that you also do is take a much higher percentage risk. What's the advantage of the married put aside from controlled risk to single digits? You're saving yourself from, now I said I could go right at the money, right? So I'm going to use that 295 put. I think that's what we're looking at. You're saving yourself from the lie of leverage or gambler's ruin. Okay. So let's just go back to this one. Let me go ahead and use the midpoint price here. This was the married put we were looking at with a 4.1% risk. Worst case scenario, but yeah, I get it. We're putting up $30,000. Oh, you're almost 31. I get it. But I've controlled my risk to 4.1%. What do I mean by gambler's ruin? Well, let's say I had $30,000 here. Let's say we had a $50,000 account. Why would I put 2/3 of it into one position? Well, because the risk is controlled to 4%. The most I can lose is 1263. Shot that down. 1263. Now, if I enter a trade, credit spread, debit spread, buy a call, and McDonald's drops down to 260, and maybe I only put $1,400, $1,500 into that long call. Great, so my portfolio is still safe. But of that $1,263 or $1,500, if I lost 50% of it, or $750, how much do I need to get back to break even? Well, I need a 100% gain on what I invested in the trade that's left after the loss to get back to break even. You know, if you take a 33% loss, you need a 50% gain on what you have left to get back to break even. And a 25%, you're going to need a 33% gain to get back to break even. That's gambler's ruin and the lie of leverage, which I know you're aware of. We've talked about this before. Odds of tens, if I take a 5% loss, do I need a 10% gain to get back to break even? No, I only need a 5.26% gain on what I have remaining to get back to break even. Controlled risk. Forcing an ideal size trade, the first of the 3 core principles of radioactive trading, avoids gambler's ruin. Why am I going through all this? Let's go back to that McDonald's option chain real quick. Did I leave it open? I did not. No worries. Just go navigate back towards it. We're going to go to January. All right. And we're going to go to medium chain. It'll probably be deep enough for us with this one here. Look at all these. First off, I want to show you all these zeros. What is that? Previous option volume, current option volume. There's some light open interest, these deep in the monies. Delta here at 0.902, 0.897, but there's no activity recently. Bid-ask spread are not as bad as you'd normally expect. This one here, bid of 76.75, 75.90, ask of 79.05. You're more likely to pay $79 for this position. And that would put you up at 299. So even with the delta, oh, I'm sorry, maybe this one here, 80, it'd probably be closer to 83. But again, even with a delta of 0.902, there's no recent activity. There's little open interest. There's some, but as we go deeper, when you're trying to get to that mimic delta of 1, there's going to be no open interest. You're probably going to be paying the ask price here at these prices. So you're still paying $8 or $9 of time premium. Why is it important? Let's stay with the 0.902 delta. I'm going to say $83 is a valid price for the 215 strike. So that would put us at 298.25 or 83. So about 295. I'm sorry, 298. So about $8 roughly of time premium that we're paying. With what else? With didn't get my cursor back. Sorry there. With the time premium of $1,263 we're risking on the proper put that we'd use for a married put. As I mentioned, static break even, not important, 307.63. We're going to have to come back to this married put. I should have kept it, but it's okay. We'll have the put in there and we can do it. Sorry about that. So let's go 322 days out. I was looking at the 215 strike. We're going to pay $83 for this. Maximum risk is $19.90, not $12.63, but I only put up $9,990 for it. And maximum risk is 20%. The lie of leverage works both ways. You're not going to get zero time value for these options you're looking for. The ones that are closest to the delta of 1.95, 0.98, 0.99 have no open interest and haven't traded. Even if you do get filled, you're going to get filled at the worst possible maximum ask price, most likely. And what have you done? You've created a leverage position and in the money long strangle. Not the same as a married put, is it? Upper break even is 314.19 instead of 307.63. You've increased it. You need another $7 movement. Now, of course, at the halfway point, you say, oh, well, yeah, you're showing a profit here at about 300. The married put would have been faster to reach a profit. 10 days, 30 days, 15 days. Every example we've run for this over the years. Hey, isn't a long call better than a married put? Isn't it the same but better? How can it be the same but better? Can I do it cheaper by buying an in-the-money call and buying a put to protect it? You create the in-the-money strangle. Here's that no man's land, Death Valley I mentioned. You need a wider movement up or down before you start losing money on the position. Then comes the issue, which some ask and say, oh, well, That's okay. My risk is higher because I had to pay into both time values. I'm not going to let this go to a 19% loss anyway. And Mike, you still teach me the 12 different income methods. So what I can do here is just do a calendar spread. I can sell that 295, or let's just call it the 300 call, same as you would in the married put right now, to generate some income. $300 call, 56 cents, same price I get, so I'm not going to say it's low. Now you're trading against yourself. Why would you have done this in the first place? Low beta stock that you're kind of bullish on, that you want to hold long term, that you're not expecting losses on. You're trying to protect it with leverage. But hey, I want to generate income to cut down my cost. Did you cut down your cost? Yeah, the max risk now is only 14.30 or 14.4%. I'm probably at 3.6% on the married put position. Now you've got two ways to lose. You can lose if it's up at 310. Oh, you've lowered your break even one down to 292, but you just have this small window of profit in this target, and the profit's only $400 against a $9,000 investment. And two ways to lose in the upside in the direction you were thinking it was gradually going to move anyway. Now, sure, it's not going to hit 300 in 14 days. Well, even the stable stocks we've seen go through wild swings when the market lifts all rising tides, right? And yeah, 225, not likely to get hit unless there's something catastrophic that happens in the market. But what's still in this range? No man's land, Death Valley, no profit, loss. Is this the structure that you want? Is this a structure that you're targeting for this portion of your portfolio? I'm showing this to illustrate the fact that in a married put, you might see the income method number one go like this. Here's the maximum loss, still have a profit up here. You don't own the stock. You own the right to buy the stock. You need the upside movement so that the gain in your long call, even deep in the money, can counter what you're losing on the put. The minute you sell that call, it's always worse delta ratio than doing it in the married put structure. There's caveats to this. Would a deep in the money call with a married put not be better? Not likely. You probably need more volatile stock. Also, what are you doing in these situations with the stocks that you mentioned? McDonald's, PG, low beta stocks, which usually do what? Pay a reasonable dividend, 1.5%, 2%, 2.5%, 3% annualized, which would cut into that 4% risk I had on the McDonald's Mary's put. Mickey D's trying to say I said MacD's. So that's a benefit that I have. Yeah, there's no easy way to make a quick buck. And what do we all know? Who wants to finish that statement? If you're trying to look for an easy way to make a quick buck, you're going to find an easy way to lose a lot of bucks. That's just the unfortunality of it. But, I don't want to deter you, okay? Calendar call spreads. You heard me say that I mentioned that I use the diagonal calendar call spreads on positions like this. But rather than doing the married put that creates the in-the-money long strangle, maybe I might just buy this 215 call for 8,300 on McDonald's and still just, hey, sell that 300. Sorry for the scrolling, folks. That near term 1 week out, 2 week out, 300 call against it for a little bit of premium. Yeah, I'd like to at least get 1% on that, or 0.1%. But set up in the right structure, I don't have two ways to lose. It's a poor man's covered call, and I hate using that term because remember, on this one, my max risk is 100% of what I invested. If this starts to move against me, this could quickly go to a 20, 30, 40% loss. I'm way out of the scale of gambler's ruin that I want to be in with that single-digit risk, okay? But it's another idea. I just wanted to make you aware that buying a call, even deep, buying a realistic call deep in the money that has activity and you can expect a fill on, creates that in-the-money long strangle position with no man's land, Death Valley, where you need a bigger movement. Every sample we've run over the years where I compared the in-the-money long strangle approach to a married put on IBM, on more volatile stocks. I think IBM was the first example we did for a customer probably back in 2010. You needed a larger movement in the stock. And in fact, the stock moved up 2.5% in the first 30 days. The married put was at a profit of 1.2%. Not the goals, but it was there. In the money long strangle was still underwater because the gain in the call hadn't overtaken the loss in the put yet. It's still in that no man's land. You're not. One thing I wanted to should have illustrated on the married put I'm sorry, the in the money long strangle. Let's see if it'll take me back to the standard one. There we go. Remember, in this structure where you're starting off, you're a little bit delta positive because, yeah, I'm at 0.9 here with my call delta, and I'm probably only at 0.65 or 0.6 here with my put. So I'm delta positive, absolutely. I am not delta neutral by any stretch of the imagination. In fact, I'm delta opposed, which means that's why you need a much bigger movement this way to start realizing profit, or you need a big swing down. I mean, this is one advantage, don't get me wrong, of the in the money long strangle. If I'm wrong and the stock completely tanks, 90 points on a $300 stock, for example, no, I wouldn't need that much, 70 points or so, 75 points, drops down to 220 here. It has that, what are we talking, 40% movement, of 35% movement, 33% movement downwards. Hey, I can profit on the downside where I'd be at a 4.1% loss on the married put. All right, you got me there. But I didn't get into this stock because it was volatile or likely to see a 25, 30, 35% drop in price. Even with bad earnings, McDonald's might only drop 6 or 7%. Something really awkward would have to be happening in McDonald's and in the market as a whole and the economy as a whole and the world economy as a whole, in my opinion, to see McDonald's drop down 33, 35, 40% from bad earnings. All that aside, let's go over. I'm going to navigate over to YouTube real quick. We're in our playlist or in the videos thing here. Here's where you can. So Maurice, this relates to your question, where to find the recorded webinars. Just go to YouTube, look up Power Options. Here's all the recent videos we posted. This is from last week's discussions. Evaluating stock trends for entering a married put position. Is it necessary to diversify the options trading portion of a portfolio? Discussion on income method 4 and income method number 5. 4-part series we put together based on one question that came in 2 weeks ago. Locking in unrealized stock gains. Exactly what Doug asked. This is one, locking in unrealized, the Power Options insurance tool, and increasing gains in return with income. Exactly what Doug had asked. Would I do that with Amazon with my cost base in 97? Absolutely. And this is the same process I would go through using the insurance tool and Power Options and evaluate how to complete, quote unquote, the hat trick for locking in gains, buying that put, and then doing the income method number 6 from the blueprint that leaves the upside open. But I want to go here. I'm going to use the magnifying glass to search on our channel, not searching on YouTube. I'm searching on the Power Options channel. I'm going to look up 3 core principles and comparisons. Wow, 6 years ago, 7 years ago, 11 years ago. This is the first one I think we did, okay? I'm just going to click on this and pause the video. There we go. What is in this video? All 3 of those videos do a comparison, and they did not keep my description. Okay. So let me go back to one of the other ones to see if they have the full description. They're all pretty much, they're similar in most respects. But this one, sorry, there we go. All right. So why am I showing you this? Okay, so from the question that came in about the in the money long strangle, these videos here, 3 core principles, trading and married put comparisons, different ones. There's ones I think that are more recent than this also, not 6 or 7 years ago. So what do? We discuss the 3 core principles for any strategy: forcing an ideal size trade, the at-the-money bell curve, and the time decay curve. Then we compare the pros and cons of these synthetic strategies. Simply buying a call. Isn't buying an out-of-the-money call far out in time the same structure as a married put, but better? How could something be the same and better? No, they are not parity trades of one another. The only parity trade to a married put, in our example that we just did, if I bought McDonald's at $2.90 and bought that $2.95 put, I think it was for $16.30 or something, and we had a maximum risk of $12.63. So that implies that if I just bought the January $2.95 call, same strike, same expiration, it would probably cost me about $12.75 or $1,300, $13 per contract. Aren't those the same trades? No. And this explains why. The only parity trade to the married put is if I bought that $2.95 January call and left the $29,000 per contract that I would have used to buy the stock on hold in my account and did not use it. So that way, I am only risking 4% of the total value. Because what are you going to do? You're just going to buy one call of McDonald's at $2.95 in your portfolio? No. You're going to buy 5 calls and have a risk of $6,000. Then you're going to buy 6 calls of stock ABC, 4 calls of stock XYZ, 10 calls of stock 1, 2, 3. Now you're overly exposed. Are you diversified? Quote unquote, yes. Are you monetarily more exposed to lie of leverage? Absolutely, and that's what typically works against you. The pros and cons of using an in-the-money long strangle or trying to time the trade. Okay, in-the-money long strangle, which we just reviewed, or trying to time the trade by legging into the stock and put by selling a cash-secured naked put to get in the stock at a cheaper price with the same married put. Those are all quote-unquote alternatives, but we don't do them for a reason. And that's what you see in these discussions. So just look up 3 core. There's a couple videos that you'll be able to see there. 3 core principles in trade comparison. And I think if I just looked up comparison too, I like using the 3 core search, but if I just looked up comparison, I'll get a lot more videos. Comparison on stock, yeah, you got to scroll through a lot more. Comparison of limited risk strategies, that's a little different. Video discuss the issues, pipe strategy, covered call. Okay, yeah, so I'm not seeing, there's some other discussions that we had. That's the 61, yeah. So just use 3 core. That is usually what I try to title them. They're a conservative strategy comparison, married put versus long collars, and deep in the money covered calls. Not what you were asking, but those ones there, Shashir, really illustrate more of those 3 examples. Why don't we talk about just buying a call instead of doing the married put to save money? Why don't we talk about the in-the-money long strangle as an alternative? Why don't we use the calendar put spread to get into the married put at a cheaper price and then continue it as a married put once we're put the stock at the put strike price? That's what's discussed there. A little bit longer because they're older, but it walks through section by section. It gives you the introduction to the 3 core principles, a little bit more in depth than sometimes you see on the more recent webinars when we just do it on the fly. Blueprint underscore see that full listing there. But then again, you get the each individual comparison, about 8 to 10 slides in each comparison of why it's not a parity trade to just the long call, why the in-the-money long strangle is not preferred for what you're looking for the stocks underlying and goals of the married put, why it's not the same, and the risks of no man's land, Death Valley there, and why we don't suggest trying to get into a married put by timing the trade by selling a put first or selling a put and buying the in-the-money put for a calendar put spread. You'll see why that's actually trading against yourself. All right. So back to the videos, Maurice. Here's where you can find the recent ones in order that we've posted, but where you can also find them, of course, on Power Options. And even if you're currently not a subscriber, you can go right to Power Options. You can click on the webinars view, and you'll see some of the webinars that are available. Now, I don't post everything here, but we try to update it from time to time. And the requested topics is the full one, the full unedited Friday discussion. Subscribers have access to all of the videos. But as you can see, as a trial member or as a non-subscriber, the most recent 5 or so are blocked out. Now, the Power Options tools, you say, oh, it doesn't look like you're editing this or updating it that much. And the reason why is because we're trying to keep this as a similar order of someone new who'd come in. It's based on time, but you're starting off with the Power Options portfolio tools, review of the market sentiment and current indicators, the profit and loss chart, reading the profit and loss chart, tools for evaluating buying calls and buying puts, functions of the portfolio tools, current market sentiment, Power Options tools for credit spreads, using the picks of the day, a better way to find a spread or iron condor and high price, so on and so forth. The Power Options top 5 tools. So even though this is now 3 years old, this Power Options top 5 tools, 90% of the same presentation I'd be giving today. Our favorite tools, the top tools, don't really change. Using the searching and analyzing how to use the historical tools, detailed charts, stock repair tools. So keeping in order sort of tools that we're trying to show new members what really is going to benefit them and how they use. That's why I don't typically update these all the time, because we're trying to keep it in a similar order, Maurice. But that's it. Free webinar section, 4 different categories. Head right over to the YouTube channel. You can go through the most recent videos, the playlists by strategy, There's about 8 to 10 videos in each strategy, which is designed to walk through an introduction of the strategy, pros and cons, criteria that we would use using the search tools, our default search criteria and why they're there, expectations, management techniques, structure. It walks through little basic A to Z of each of the strategies. And we've got about 10 or 15 strategies here. And then there's one on earnings discussions, radioactive trading, most popular, mathematical edge of radioactive trading, and others also. But as we just showed, Maurice, if you want to look up something specific, just use the search function, use the magnifying glass on the YouTube channel. Let's just type in income methods. So even though we had that recent discussion the other day, you'll see introduction to a new income method in the blueprint, the role of the income methods 3 years ago and 5 years ago, one of the most common income methods. Here's the one recent discussion on married put income methods, best ways to generate income, pros and cons of certain income methods, number 4, number 6, an updated look at married put from a year ago, is it time for an income method, so on and so forth. You could look up covered call, you could look up credit spreads, you could look up 0 days to expiration. I put O, but there it is, yeah. Setting up a 0 days to expiration search, risk and benefits of 0 days to expiration, poor man's covered call, iron condor probability, 0 days to expiration, so on and so forth. All right, so that's what you have there, Maurice. Those are the ways you can do it. Check out our YouTube channel, go through the videos or do a search. On Power Options, just click on your free webinars tab.